Hello, dear students of MCOM Semester 1. I am Dr. D.K. Mitra, Postgraduate Department of Commerce and Business Management, Kolan University, Chaivasa. Um, this online class, I have arranged for MCOM Semester 1, the subject being Financial Management, and the topic of discussion is sources of financing working capital. Dear students, very good morning to all of you. I start the class right now, and if you have any questions afterwards, you can WhatsApp the questions to me. I will be giving you the number. What's my WhatsApp number to you? Dear students, before we go to the sources of financing working capital, let us first see what is actually working capital, what we mean by working capital. As you know, that funds needed for short-term purposes. You can take example like purchase of raw materials, payment of wages, or any day-to-day expenses. I mean the funds required for any short-term purpose. That is what we understand by working capital. Okay, in other words, capital required for short-term or current assets such as cash, debtors, inventories, and receivables. This is what we understand by working capital. Now, let us go to the sources of financing working capital. What are these sources? There are two types of sources. One is long-term source of financing working capital, and another is the short-term source of financing working capital. Let us first discuss the long-term sources of financing working capital. Right? There are basically five major sources of financing working capital, dear students. Number one is the shares, the debentures, public deposits, plowing back of profits, and loans from financial institutions. Now let us come to the shares first. Okay, now as you know that there are two types of sources, preference shares and equity shares. Preference shares always enjoy, or they carry preferential rights. Preferential rights towards what? That in respect of dividend at a fixed rate, and in regard to the repayment of capital at the time of liquidation. This is what we understand by preference shares. Now these preference shares are of different types. It may be it may be convertible debentures. Before we now first let me say what is equity shares, right? Whereas other than preference shares, there are equity shares also which do not have any fixed commitment, right? The equity shares do not have any fixed commitment, and the dividend is paid subject to availability of sufficient long-term working capital by issue of shares. So this is what we understand by the equity shares. So equity shares actually they do not have any fixed commitment in respect of the dividend. It is payable only subject to the availability of profits. Now the second one is the debentures. Debenture holders are paid interest at a fixed rate of interest, and this interest is charged against profit and loss. So debenture holders actually, when we raise loans from the market, uh, then the company issues debentures, right? See, the holders of the debentures, they are payable interest at a fixed rate, okay? And when debentures are secured, that is having floating charge on assets, are paid on priority to other creditors. Okay. Now, there are several types of debentures. Okay, there may be simple debentures, naked debentures, or naked debentures we mean by the unsecured creditors. Then unsecured or mortgage debentures, redeemable or irredeemable debentures, convertible or non-convertible debentures. There are different types of debentures. I'm not going to the different types of debentures, but let me tell you that the redeemable debentures, it is redeemable, means after a on liquidation or after a predetermined period, the repayment is done to the debenture holders. And irredeemable debentures, the company right now in the 1988 Amendment Act, amendment done in the Companies Act, irredeemable debentures the company cannot issue right now. This amendment was done in the year 1988. Okay, and company can only issue redeemable debentures, and the redeemable period maximum it can be 20 years. Now, there are several advantages of debenture, like say interest is payable on certain predetermined intervals at a fixed rate, uh, get priority on repayment at the time of liquidation. There is a retention of control, tax benefits are there. So there are several advantages of this debentures. Okay, I repeat, the interest is payable on certain predetermined intervals at a fixed rate, get priority on repayment at the time of liquidation, retention of control, tax benefits, etc. Now let us come to the third one, that is public deposits. They are the fixed deposits accepted by business enterprise directly from the public. Okay, they are the fixed deposits accepted by a business enterprise directly from the public. This is what we understand by the public deposits. Public deposits. There are several advantages of public deposits, of course. That is, number one, simple and convenient source of finance. There are tax benefits. There is no need of security, and inexpensive source of finance. It's not that expensive, very much inexpensive source. There are dangers also. There are dangers also of these public deposits, like uncertainty, then it is unreliable, unsound, unrealistic source. uh, Now let us come to the plowing back of profits. You know, right from the BCom onwards, you have understood what is this plowing back of profits. Plowing back of profit means the reinvestment by a concern of its surplus earnings in its business. So it means reinvestment by a concern of its surplus earnings in its business. It's an internal source of finance and is most suitable for an established firm for its expansion, modernization, replacement, etc. So there is a purpose of plowing back of profits. It is for the established firms only, and when the established firm needs finance for or working capital for its expansion, modernization, replacement, etc., then they reinvest their surplus earnings. So this is what we understand by plowing back of profits. There are advantages, there are disadvantages. Advantages, we can say, like cost free source of finance. It's cost free. There is no need to keep securities, no dilution of control, stable dividend, gains confidence of the public. There are dangers also, like may lead to monopolies, misuse of funds, overcapitalization, and speculation. And finally, the last major source of financing working capital, I will say that it's loans from financial institutions. In India, there are several financial institutions which finance working capital, long-term working capital. That is, say, commercial banks are there, life insurance corporation is there, IFCI is there, Industrial Finance Corporation of India, then state financial corporations, SFI, state industrial development corporations, IDBI, Industrial Development Bank of India. Interest is charged on such loans at a fixed rate. This source of finance is more suitable to meet medium term demands of working capital, right? Uh, Now, let us come to the short term financing of working capital. There are several sources of short term financing working capital. There may be commercial banks is a very major source of providing finance for working capital, like loans, cash credits, overdrafts, purchasing and discounting of bills. Then number two is indigenous banks, number three is trade credit, number four is installment credit, there may be advances, number five, and number six is accounts receivable credit. Now, first, let us come to the commercial banks. This, as you know, as I have just now said, that it is the most important source of financing short-term working capital. There are different forms, like when we take loans, when bank makes an advance in lump sum against some security. This is what we understand by loans. When bank makes an advance in lump sum against some security. Number B, cash credits. Now, what is cash credit? Cash credit allows customers to borrow money uh, up to a certain limit against some tangible securities, right? So, it allows customers to borrow money up to a certain limit against some tangible securities. Number three, that is C, overdrafts. You know what is overdraft? It's an arrangement with a bank by which a current account holder is allowed to withdraw more than the balance up to a certain limit for a short period. Now, number D is purchasing and discounting of bills. I am not going to discuss in detail what is discounting of bills. You have studied right from your class 12, class 11 and 12. What is discounting of bills or what is purchasing of bills. Actually, bank lends without any collateral security. In purchasing and discounting of bills, bank lends money without any collateral security. Now come to number two after commercial banks, uh, indigenous bankers. You know what is indigenous bankers? They are private firms or individuals who operate as banks, receive deposits and give loans. They are private firms or individuals who operate as banks, receive deposits and give loans. Nowadays, with the development of commercial banks, indigenous bankers have lost their monopoly. But even today, some business houses have to depend upon their bankers for obtaining loans to meet their working capital requirements. Come to number three, that is trade credit. Trade credit is the credit extended by suppliers who let you buy now and pay later. So trade credit is the credit extended by suppliers who let you buy now and pay later. Trade credit is an essential tool for financial growth. Trade credit arrangements of a concern with its suppliers is an important source of short-term finance. Advantages are there, of course, of trade credits, like it's very convenient method. obtained on favorable terms. Also, it is flexible. Then there are dangers also. There are dangers, of course, of this trade credits. That is, number one, I can say, charging of high prices, cash, loss of cash discounts. Okay. Now come to number four, installment credit. Assets are purchased assets are purchased and the possession of the assets is taken immediately, but the payment is made in installments over a predetermined period of time. Interest is charged on unpaid balance. So in installment credit, dear students, assets are purchased and the possession of the assets is taken immediately, but the payment is made in installments over a predetermined period of time. Interest is charged on unpaid balance. This is very, it must be very clear to you. Then there are advances. Coming to number five, some business houses get advances from their customers as well as the agents also, against orders, of course. Okay, the business houses get advances from their customers sometimes, and from the agents also, against orders. This must be very clear to you. And number six is accounts receivable credit. This is raising finance through the sale or mortgage of book debts, that is your debtors. You are raising finance through the sale or mortgage of book debts. Finance companies provide finance to business concerns through outright purchase of accounts receivable or against the security of accounts receivable. Okay, so this is what we understand by the accounts receivable credit. It is raising finance through the sale or mortgage of the book debts. That's all, dear students. Thank you very much. Once again, I tell you that if you have any confusion regarding this topic or anything regarding the financial management, you can post the questions to my WhatsApp number. My WhatsApp number is 7480873115. 7480873115. This is my WhatsApp number. You can send the questions to my WhatsApp. I will be giving answers to your questions. Thank you, dear students, once again. And from here I would like to request all the teachers of the commerce faculty to share online classes. Honorable Vice Chancellor has requested us to post online classes to the Kolan University website. Please do post your online class, but one thing I would like to say, that you have to be very specific, you have to be very subject specific while posting your online class. Okay, so you please post your online class to the Kolan University website. Thank you once again, dear teachers, dear students as well. I want to share with you one thing, that you have to at the present moment, due to the outbreak of coronavirus, then dangerous virus, please do stay home and stay safe. Thank you so much.